3 consecutive months of hotter than expected data have complicated the Federal Reserve's path ahead. It's now a matter of if, not just when, interest rate cuts will come. Joining us now is Wall Street Journal's chief economics correspondent, Nick Timiraos. Thank you for joining us here today. What's going on with the Fed here? It doesn't seem like we're going to get those rate cuts in June. We started out the year expecting 6 to 7, depending on how you measure it, and now we're barely holding on to 2.
Well, I think there are three basic scenarios here for the Fed. One is that you have strong growth with inflation making steady progress lower. That's where we were in December, and it's where the market hoped we would be right now, but it's not where we are after the reports in January, February, and then for March this week. Second scenario is strong growth, but inflation sticky or hanging closer to 3% using the Fed's preferred gauge than to 2%. That could be where we are now. It's not the worst case scenario. The third scenario, which I would say is the worst case scenario, is growth contraction with high inflation. So, I think the golden path that Austan Goolsbee keeps talking about, that's not where we are right now. But I think the question going forward is, are we still going to see sort of bumpy but progress down in inflation? You can make a case for that. Or are we going to stick closer to, say, 2 3/4 on core inflation using the PCE and with decent growth? So I think those are the two scenarios. You kind of have to put more mass on the second one being a possibility now.
Nick, what would it take to get inflation back to the Fed's target? When you're speaking to economists, what do they tell you?
Well, I think, if you look at where things are today versus where they were a year ago, you have a funds rate that's still a little bit higher and inflation rate that's lower. So you now have a funds rate that's meaningfully above the inflation rate. I think the other big change is that wage growth has continued to slow. So a year ago, I think the big worry was the Fed's going to have this last mile that's going to be really difficult because wage inflation is going to require them to really soften the labor market more. And, this week, obviously, there are more concerns now about the last mile, but you still see wage growth trending lower. You see signs that the labor market isn't as overheated as it was. And so I think there's a question here over, what's the inflation process? What's happening with inflation right now? One story would be that aggregate demand is very strong. Nominal income growth is just allowing businesses to take price more. And you see it, some quarters it's in goods, now it's in services. And so that's a concern, obviously, for the Fed. The other story would be more of a bottom-up explanation that says, look, car prices were high, very high 3 years ago, 2 years ago. And so if I wrecked my car insurance company took a bath on it because they hadn't accounted for car prices going up so much. And so now they're having to raise insurance prices. And this week in the CPI, we saw motor vehicle insurance up 20%. But if car prices are no longer going up so much, then you might have more confidence that, this is just a ripple effect through the economy and that'll settle out. But I think the jury's still out right now on which of those inflation stories is going to be, the story we look back on in 2 or 3 years and say, this was the right one.
Nick, I want to get your opinion and your view as a reporter on the Fed beat. We hear a lot of Fed speak, and today is no different. You mentioned Austan Goolsbee. He said earlier today, multiple inflation readings are higher than we want. Bostic said earlier, I'm not in a hurry to cut rates or interest rates. And a lot of times these statements seemingly conflict, and they can also evolve in quite different directions from person to person. How do you put all these pieces of the puzzle together when you're trying to convey a story to the public?
Well, I actually don't think it's that difficult now because of the March inflation reading. There was some water building up behind the dam in the sense that, January was high, February wasn't as high, but it was still higher than expected. And so Powell and others have sort of said, well, this could be seasonal. This could be a bump. But March was really going to either validate that story or punch a big hole in it. And March punched a big hole in it. So I think you now see across the board the more hawkish officials who had been saying, I really don't see a reason to cut interest rates. They're still saying that. You don't hear a lot of talk about, hiking rates again, but I think the hawks now feel even more emboldened and more confident in this position of what's the rush. Lori Logan, the Dallas Fed president last week, saying it's much too early to talk about rate cuts. And you have to feel better about that view after you see the March CPI. I think the Dubs on the committee have probably, they don't have the wind at their backs anymore, obviously. And so now, their view is going to be, we'll have to wait longer to cut interest rates. I thought Susan Collins, the Boston Fed president, made interesting points yesterday when, she argued that the labor market looks healthier than it did at the beginning of the year. So we're worried about cracks in the labor market. You don't have to worry as much about those now. That's one less reason that you might be preemptive with rate cuts. And then financial conditions have loosened. And so it calls into question whether monetary policy is as restrictive as you thought it was. And she said both of those points, even before you get to the inflation numbers, may weaken the urgency to lower interest rates. So I think we're now everybody's going to dial back their expectations for when you thought the easing cycle was going to start and how much you would ease this year.
Nick, as we head into the weekend here, geopolitics top of mind for investors. I'm looking at oil, Brent. We're back at 90 here, Nick. How does that impact the Fed's thinking?
It's too soon to say. I think it's just too soon to say. There isn't anything magical about 90, but obviously, the direction is important. And so I think we'll just have to see here. I really think the bigger question right now is about the labor market and whether you think there needs to be more of a slowdown in the labor market to be confident that you're going to get on top of inflation. And that story has yet to play out.
Nick, last question here. Want to talk about quantitative tightening, the Fed's wind down of its multi-trillion-dollar portfolio. That's going to come to an end, and that's been kind of this, I don't want to call it a sideshow, but it's been not something in the direct, it's in the periphery, not in the direct view of investors necessarily. With that, can we expect some kind of signaling? The Fed said that they're going to probably slow down the rate. How important is that piece of the puzzle here to the overall monetary policy decisions of the Federal Reserve?
I don't think it has any bearing really on their monetary policy decisions. They've tried to separate that from their policy decisions. And I think they've been signaling for a while that they aren't stopping the runoff of the balance sheet. They're slowing it. And they're only going to, the minutes this week show that they're really only talking about slowing down the runoff of the Treasury holdings. They have caps both on Treasuries and MBS. They will only allow up to $60 billion of Treasuries to run off, $35 billion for MBS. Mortgage prepayments have been low, so those caps aren't binding. So they're not going to change the cap on MBS. But it sounds like they are preparing to lower the cap on the Treasury redemptions every month. But I really, it doesn't seem like a big deal right now because it's not something that is tied to their monetary policy ambitions.
All right. Well, always good to close on some talk about some wonky bond market mortgage terms here at the end of the day on a Friday. Really appreciate you stopping by here, Nick Timiraos.
Thank you.